Hey everyone, welcome back to another exclusive podcast from IronFX, where we're dedicated to bringing you the absolute best education to help you take your trading to the next level. I'm your host, Desmond, and today we're diving into a strategy that's often debated in trading circles, the Martingale Strategy. Right? Does it work, or is it a recipe for disaster? Let's find out. The Martingale Strategy is a betting technique that originated in 18th century France and was developed by mathematicians studying probability and gambling systems. At its core, the strategy revolves around the idea of doubling your stake after every loss, with the assumption that a win will eventually occur, recouping all previous losses and delivering a profit equal to your original stake. In the trading world, this principle has been adapted to financial markets, where traders double their position size after a loss in the hope of recovering and making a profit when the market eventually moves in their favor. Let's break down how the Martingale strategy works in a trading context. Initial trade. Start with a small initial position size. For example, let's say you open a position worth $100. After a loss, if the trade results in a loss, double the position size for your next trade. In this case, your next position would be $200. Repeating the process, continue doubling the position size after each loss, $400, $800, $1,600, and so on, until you finally achieve a winning trade. Recovering losses. The winning trade is expected to recover all previous losses and generate a profit equal to your initial position size. While the logic may seem sound mathematically, the strategy relies on the assumption that markets will eventually reverse in your favor, a risky proposition in volatile or trending markets. Now, let's weigh the pros and cons of using the Martingale strategy in trading. Pros: 1. Mathematical certainty. In theory, if you have unlimited capital and there are no market constraints, the Martingale strategy can theoretically recover losses and deliver a profit. 2. Simplicity. The strategy is straightforward to understand and implement, making it appealing for traders looking for a structured approach. 3. Potential for quick recovery. In a range-bound market where reversals are common, the strategy can help recover losses quickly. Cons 1. High risk of significant losses. The exponential growth in position sizes after consecutive losses can quickly deplete your trading account. 2. Margin requirements. As position sizes increase, margin requirements also rise, which can lead to forced liquidations if your account lacks sufficient funds. 3. Market realities. Markets don't always reverse, and prolonged losing streaks are more common than many traders realize, especially during trending conditions. 4. Limited by capital. Most traders lack the unlimited capital needed to sustain consecutive losses without catastrophic consequences. The Martingale strategy's biggest flaw is that it assumes infinite resources and doesn't account for real-world constraints like margin calls or market volatility. Let's look at a couple of examples of how the Martingale strategy might play out in trading. Example 1. Forex trading. Imagine a trader uses the Martingale strategy on the EUR-USD pair, right? They start with a $100 buy position at 1.1000. The market drops and they lose. The trader doubles their position to $200 at 1.0900, and the market drops again. They now open a $400 position at 1.0800. If the market reverses to 1.1100, the trader recovers all losses and makes a small profit. But if the market continues trending downward, the losses compound quickly. Example 2. Stock market trading. A trader starts with $1,000 invested in a stock, expecting a bounce. The stock declines and they double their position to $2,000. If the stock rebounds, they recover losses and profit. However, in a sustained downtrend, the trader could face a margin call or wipe out their account. Right? These examples highlight the potential gains but also the catastrophic risks associated with this strategy. So, does the Martingale strategy work? While it can seem appealing in theory, its high-risk nature and reliance on market reversals make it unsuitable for most retail traders. Effective risk management and a well-thought-out trading plan are far better tools for long-term success. Thanks for tuning in, and in the meantime, do remember to subscribe to our podcast here at IronFX, where we're dedicated to bringing you the very best education to take your trading to the next level. Until then, stay informed and stay tuned.